Hey Parallax traders, this is Imri and welcome back to another video in our educational Elliott wave and trading series. In this video, I'll be covering a common question that I get, and it's a common question for good reason. It has to do with the flat. The flat pattern in Elliott wave, well, in all financial markets, regardless of whether you're using the Elliott wave principle to analyze those markets or not, is irrelevant. You'll see flats regardless of whether you subscribe to the wave principle or not. But the question is, how can we avoid getting trapped by flats? Because flats, you see, are one of the trickiest corrective patterns out there. They're tricky because they tend to trap traders in both directions. Now, the example here is in a bull market, so you would just inverse these waves if you wanted to know what it would look like in a bear market. So a flat is a 3-3-5 corrective structure. And again, this is where, objectively speaking, the wave principle gives you an advantage that nothing else out there will give you, and that is context. So a lot of technical analysts would see this pattern and call it a double top, double bottom, a rectangle, maybe a flag, I don't know. And I get it. Those statements would not necessarily be incorrect, but where the wave principle goes a little bit further and gives you that undeniable edge is that it demands more specificity. All right, so what exactly is a double top? What exactly is a double bottom? Well, when we're dealing with double tops and double bottoms in Elliott wave language, we're referring most commonly to flat corrections. Occasionally, like a triple top or a triple bottom would be a complex flat correction, like a double three, or even a triple three in very rare circumstances. But anyway, where the wave principle gets more specific is that it demands that the flat be labeled as a 3-3-5 pattern. Otherwise, it can't be a flat. So what that means is that we're going to use letters to label the flat, and I've labeled the flat using A, B, and C in parentheses here. So we have A, B, and C in parentheses, okay? Now, what happens with a flat is that wave A and B will unfold as three wave patterns, all right? So wave A of a flat will be labeled A, B, and C. Wave B of a flat will be labeled A, B, and C. And then wave C of the flat here will always unfold as a five-wave sequence, whether as a standard impulse wave as we have here or as an ending diagonal. Okay, so flats are 3-3-5 sequences, and that's your first clue as to whether or not you're dealing with a flat. So let's say, I see this, three-wave corrective decline. I'm buying the breakout. I'm going long the market around here. Well, now here's the clue. Is the advance only in three waves? If the advance is only in three waves, and you get a fourth wave pullback that overlaps with the top of this wave here, well, that's a clue that you're probably dealing with a flat, because one of the rules of the wave principle is that wave 1 cannot end within the price, wave 4 cannot end within the price territory of wave 1. Okay, so what that means is that I'm just gonna move my drawings down here. All right, so what that means is that if we have wave A of the flat completing here and we're going long, we don't know that this is just a B wave high, okay? We don't know that this is just part of a larger flat, but we're going long the market somewhere around here. Use this arrow again. So we're going long the market somewhere around here, okay? Well, what you're going to see in this B wave advance on a smaller time frame is 1, 2, 3, 4, 5 for wave A of B, a 3-wave setback for wave B of B, and then likely a 5-wave move for wave C of B, okay? So this is wave A, B, and C, and this zoomed in portion, okay? This zoomed in portion that we're looking at right here, that's B. And remember, wave B of the flat will have its own three-wave corrective sequence, which is what we're looking at here, A, B, and C, okay? So when we're tracking the advance in the flat, and this is wave, let's say this is wave 1, right? Like I said, we don't know it's the flat. This setback is wave 2. This 5-wave advance is wave 3. What we're gonna get next is, if we're dealing with an impulse, is a 3-wave setback in wave 4, followed by a 5-wave advance for wave 5. Okay, then that's a complete market cycle. But what's going to happen in the case of a flat is that instead of a 3-wave corrective setback, you're going to start seeing a 5-wave move down for wave C of the flat, that is, all right? Now, crucially, you're going to see this overlap, all right? That's when you have to switch your labels from this 1, 2, 3, 4, and 5. You have to kind of abandon that idea and you have to switch to this alternative interpretation, which is A, B, and C. Now, in many cases, almost all cases, if you follow this rule, you'll be able to limit losses. The reason you'll be able to limit losses is because you're probably going to exit that trade if you're able to keep a close eye on it roughly around the point you entered, or you might even escape with tiny profits, okay, if you want to be very aggressive trading here. So the first hint as to whether you're dealing with a flat or not is if this B wave unfolds in 3 waves. But I understand in real time it's tricky to anticipate that given the example I just gave you below the structure on the price chart, okay? So I understand that it's tricky to make that determination in real time. So what we can do is look at the other clues that the market's giving us. The next major clue is the theory of alternation, or the guideline of alternation. The guideline of alternation between corrective waves states that if wave 2 is a sharp correction, we can expect wave 4 to be a sideways correction. Now, I'm not going to say that wave 2 is always sharp, but more often than not, it is the sharp correction within a 5-wave sequence. So what do I mean by sharp? I mean wave 2 commonly targets 61.8% as far as a Fibonacci retracement goes of wave 1. My apologies. Let me just give this entire sequence some labels, right? Okay, there we go. So we can see that wave 2 retraces quite a bit of wave 1, whereas wave 4 only retraces roughly 38.2% of wave 3. That's what I mean by sharp versus sideways corrections. So if wave 2 is sharp, wave 4 is likely to be sideways. So if we see a sharp correction for wave 2, then we can anticipate a more sideways correction in wave 4. Another hint that we have is that zigzags are part of the family of sharp corrections. So if we get a zigzag, like we see in wave 2 here, and then we see this little zigzag here for wave 4, well, that's not sharp. It just doesn't correct enough of wave 3, all right? It doesn't even touch 38.2%. A zigzag typically goes 50% at least of the prior wave, if not more. So if you have a situation where you have this zigzag, my mind is going to go to a couple places. But what other corrective patterns have a zigzag as a component of that larger corrective pattern? And the answer is a flat, which is what we're seeing here, but it could also be a triangle. It could also be a double zigzag, all right? In all of those cases, I would not be able to conclude with a high degree of certainty that the entire correction is over after the first shallow zigzag. So I'm going to have to wait for more price action to develop to see if we get a triangle, a flat, or a double zigzag pattern. In this case, we're dealing with an expanded flat, okay? Expanded because wave B makes a new high, new price extreme above the end, above the beginning of wave A, and wave C makes a new price extreme below the end of wave A here, all right? So those are the best clues that you can use when you're trying to identify whether or not you're accidentally trading a B wave within a larger flat pattern. Now here are some other clues. So I've labeled this larger flat, and wave C of that flat, this expanded flat, ended in March of 2020, right? The COVID flash crash. Okay, so there are some other clues that we can discern. Now I remember this because I was tracking the market in real time, right? Back in the turn of the new year, right? Beginning of 2019, I was following this this corrective setback, okay? And then this is a very typical zigzag. So I'm expecting a 5-wave advance, which we get. And then I'm expecting a 3-wave setback in wave 2. All right, we got the 3-wave setback. Now I'm thinking in my head, well, that's a zigzag, but zigzags, like I said, tend to be sharp corrections. And this one barely, it hasn't even reached 38.2%, right? So it doesn't really qualify as a sharp correction. Now, does that mean we'll never get a situation where wave 2 is a shallow correction? No, it does happen, but they are called exceptions for a reason. So in my head, I remember this very clearly. I was wondering, all right, what is going to come next? Are we going to get a double zigzag? Is it going to be a flat scenario for wave 2? So in my mind, I was figuring either a flat or a double zigzag had to occur in order for this to really, really make some sense. The only thing that would convince me otherwise was a clearly impulsive move above the high here. So at that time, I didn't have this wave A label. I had a wave 1 label here. Okay, I had a wave 1 label because I could count 5 waves off the low. But what happened over the next several months is what convinced me otherwise. We got a triangle. All right, so this sideways pattern is not a flat, it's a triangle. Now, for those of you that know a little something about Elliott, you know that triangles can never take place in wave 2 position. Triangles always precede the final actionary sequence within a larger cycle. So in this case, if there was a triangle, it had to be wave B. That's when I realized that we're dealing with a larger multi-year corrective pattern. Okay, so 2018, wave A of the flat completed, and then in 2020, February of 2020, wave B concluded. So a multi-year flat pattern. And the biggest clue was this triangle. Triangles cannot appear in wave 2. So once we had, 5 waves to the upside, and this was far, by the way. I remember expecting that 5th wave. It was just a silly anecdote, but look here, 1, 2, 3, 4, and 5. I thought around here was enough, and then I thought we'd get that big crash. So I'm just saying, I don't always get it perfectly right, but when I do get it wrong, I bounce back very quickly because I'm consistently utilizing the rules and guidelines of the wave principle, right? So we got this little decline, I'm going short the market, and then, we get an impulsive rise. Okay, fine, all right, we're not quite done yet. This is either still part of wave 3 or part of wave 5, something like that. We have to be a little bit more patient. That's fine, but my losses are limited, and my wrongful analysis of the market is also limited because I can immediately pivot to the alternative scenario. So that's just an anecdote, okay? Again, illustrating the power of the wave principle. One of the most important features that the wave principle provides to traders and investors is that it helps tell them when they are wrong. That's arguably more important than telling you when you are right. Because the name of this game, if you want to play this game for the rest of your life, is longevity. It's consistency. It's staying alive to make another trade tomorrow. Anyway, back to the flat pattern. So that's the other big clue, is if you get wave B within a larger flat, if you get a triangle within that 3-wave rally, then you know for sure that you're dealing with a corrective sequence that's going to be fully retraced. Okay, so those are your clues, all right? You want to pay very close attention to how that B wave is unfolding, and if you see a triangle in that middle of the sequence, then you know for a fact you're dealing with a corrective sequence. Now, I will admit there are times when I'm going to get aggressive in the market and I'm going to trade, and in my mind I'm thinking, well, this is either the start of a new impulsive cycle or it's just wave B. So I'm trading, but I'm aware of the possibility that I'm trading into a B wave top. So that's where I'm going to be very quick to trail a stop to manage the risk on that trade in order to exit for a very, very minimal loss, a small profit, or roughly at break even. Okay, so there are times when I will get aggressive, but that's just a personal preference. The best thing to do, in my opinion, if you want to hit a consistent win rate over time and you're not quite yet advanced enough to be able to take these ultra aggressive trades, the best thing to do is look at wave 2, see the relationships between wave 2 and wave 1 if we get a sharper sideways correction, and then you can extrapolate what wave 4 ought to look like most of the time. Okay, hope this video was helpful. As always, please, if you have any questions, just let me know. Thanks. See you guys in the next video.